Hi, my name is Jesse Wilfred Burata. I'm a BSB student from St. Peter's College, and today I'll be discussing about ratio analysis. So what is ratio analysis? Ratio analysis involves the comparison of financial data. So when we say financial data, it is the information about a company that tells you about its financial health and performance. So ratio analysis requires the differentiation of financial data to acquire or gain understanding into how businesses performing. And these are the questions that ratio analysis helps to answer. Number 1 is, why is one business more successful or money-making than other? Number 2, what returns are being earned in investment in a business? Number 3, is a business able to stay debt-free? And lastly, how effective or how well they manage their business using its resources? And where does the information for analysis come from? Income statement and balance sheet. Income statement, also known as profit and loss statements. It summarizes all income and expenses over a given period, including the cumulative impact of revenue, expenses, cost of goods sold, gross profit, and income before taxes. And balance sheet is a financial statement that reports a company's assets, liabilities, and shareholder equity. The balance sheet distinguishes between current and non-current assets. And number 2, assets and liabilities. Assets expected to be liquidated or used up within 1 year, which is greater, are classified as current assets. Liabilities expected to be settled or paid within 1 year, which is greater, are classified as current liabilities. And number 3 is trade receivables, also referred to as accounts receivable, are amounts owed to a company by its customers for products and services already delivered. And inventories are physical products that will eventually be sold to the company's customers, either in their current form or as inputs into a process to manufacture a final product. And the 5th is long-term liabilities. Long-term financial liabilities includes loans. For example, is borrowings from banks, and also includes notes or bonds payable. For example, is fixed income securities issued to investors. Therefore, these two documents are designed for different uses. An income statement tallies income and expenses. A balance sheet, on the other hand, record assets, liabilities, and equity. And these are the steps involved in financial ratio analysis. Number 1 is an analyst should determine the objectives of ratio analysis. Number 2, select the suitable ratios on the basis of objectives of ratio analysis. Number 3, computation of the selected such ratios. Number 4, comparison of the calculated ratios with the ratios of the same business concern in the past. Number 5, comparison of the calculated ratios with the same type of ratios of other similar business concern. Number 6, comparison of the calculated ratios with the same type of ratios of the industry to which the business concern belongs. And lastly, the explanation or the interpretation of the ratios. Financial ratio analysis are grouped into the following categories. Number 1 is profitability ratios, liquidity ratios, solvency ratios, and valuation ratios. Profitability ratios measure a company's ability to generate income relative to revenue, balance sheets, assets, operating costs, and equity. Liquidity ratios are financial ratios that measure a company's ability to repay both short-term and long-term obligations. Solvency ratios measures how well a company's cash flow can cover its long-term debt. And the valuation ratios. The point of valuation ratio is to show the price you are paying for some stream of earnings, revenue, or cash flow. Uses and users of financial ratio analysis. Track company performance. It is determining individual financial ratios per period and tracking the change in their values over time is done to spot trends that may be developing in a company. For example, an increasing debt to asset ratio may indicate that a company is overburdened with debt, and may eventually be facing default risk. Number 2, make comparative judgments regarding company performance. It is comparing financial ratios with that of major competitors is done to identify whether a company is performing better or worse than the industry average. For example, comparing the return on assets between companies helps an analyst or investor to determine which company is making the most efficient use of its assets. Users of financial ratios include parties external and internal to the company. External users, they are financial analysts, retail investors, creditors, competitors, tax authorities, regulatory authorities, and industry observers. And the internal users, they are management team, employees, and owners. That's all. Thank you for listening. I hope you've learned a lot from my reports.